Good day, traders. The old saying is that money makes the world go around. The new one, well, for the past 50 years or so, is that it's oil. In fact, the world's economy is so reliant on oil still that wars are fought over it and entire continents become subject to whims over it, even those that have their own. Today, we're looking at the correlation between two trading benchmark assets, the S&P-500 main US stock index and the price of crude oil. The S&P because it's considered the main index by which you can pretty much gauge how well the US economy is doing. And crude oil, which is the price of the West Texas blend, the one that's produced in Western Texas, and consider the benchmark for US oil pricing. Now, you'd think that saying that US economy is dependent on US oil is almost redundant, but with the world moving towards alternative energy, and with so much industry being high-tech and not energy dependent, there would have been a divorce between the two by now. But no, let's face it. In a country as large as the US, if you can't fly around or drive around those huge open spaces, nobody's going to get to those high-tech jobs. And without proper heating and air conditioning, nobody's going to want to. In short, with energy and mining, we're talking about 11% of the total economic activity in the US, or about 2% of the economy. Now let's take a look at how the correlation plays out. This is a graph showing oil prices in red and the value of the S&P in gray, ranging from the latest plunge last December. There's hardly an action in one that's not reflected in the other. We've got the same double bottom here in December just before the plunge, and another one here ranging from mid-January to mid-February, heralding the recovery in oil prices. What we have up here is a massive resistance level in the S&P ranging between 2040 and 2100, and in oil between $38 to $43 a barrel. The main difference here is volatility, and that may give us a hint as to what is going to happen next. Look at today's oil trading after I ran through a ratch into the proposed production freeze, and after the U.S. Energy Information Administration cut its forecast on Brent oil to $34 a barrel. Oil is red and it's on its way down. Now we're looking at the S&P as it continues consolidating towards Wednesday's interest rate decision from the US Fed. So what's happening? Has the relationship been broken, or are we waiting for a correction? Well, before making up our minds, let's go back to our first graph for just a moment and look at where we weren't looking. Here, this right-hand edge where the two assets split. Could oil be coming back towards the S&P, or is something about to happen with the S&P? What's clear is that when you have two assets that usually coincide and then the equilibrium is broken, it makes for great drama. So look out. The week may be starting quiet, but there are definitely clouds on the horizon. These could be geopolitics for oil, another closure for major ports, violence amongst producers, and so forth. An agreement on production cuts in spite of Iran's refusal, who knows? The S&P could be influenced by tomorrow's Producer Price Index or Wednesday's Consumer Price Index, both influencing inflation and, of course, Wednesday's rate decision from the Fed. So put your money management system in order and pay close attention. We'll be back again tomorrow. Till then, happy trading.